Hello and what is going on, lovely people of the internet? It is HOOTMONEY here with another video for you guys today. Today we're going to be talking about the current meme stock rally and why it has potential downside risks to the overall market. Now, with that being said, yes, these meme stocks are trading at high valuations and they have been going to the absolute moon. We've seen stocks like AMC, GameStop, and Clover Health go to absolutely ridiculous valuations, way overvalued based on fundamentals alone. Now, you may disagree with me on that. However, if you do look at their fundamentals, such as their price to sales, some of their balance sheets, you will see that yes, they do not deserve these prices as of now. Now, that can change in the future, but as of today, these valuations are just way too overvalued. Now, with all this speculation, there is some downside risk to the overall market, and we're going to be going over that today. In fact, we're going to be taking a look at a segment from Fast Money on CNBC to see what this analyst has to say about the meme stock rally and basically give an explanation of why there could be a correction in the S&P 500 following this rally. There are very interesting points in his response, and I will be commentating alongside so you guys understand the gist of what's going on. I'm going to try to break it down for you guys in a very simple, easy to follow way. So if you guys enjoyed this content, make sure you guys leave that early like on the video. Liking the video is the number one thing you can do to help out a small content creator like myself. If you guys would like to get up to $50 in free stock with no deposit required, you can sign up for Public using that link below in the description or in the pinned comment section. And yeah, you get up to $50 in free stock, so it's basically free money just for signing up. I'm a partner, so it helps support the channel. And with all that being said, Public is an amazing investing platform. I love it. It's my favorite one to use. It's my favorite mobile app. It's way better than an app like Webull. Webull is just kind of difficult to use, so I don't even like Webull. Robinhood is not difficult to use, but Robinhood has horrible customer service, so I'd like to stay away from Robinhood. And Public has the best of both worlds, where it's great customer service and it's very easy to use. So that's why I like Public. That's why I think you guys should use it as well. That's the only reason I support it on this channel. I wouldn't support it if I don't like using it. So I like using it. It's an investing social media application, so you can see everyone's portfolios. You can follow me and see our YouTube stock portfolio on Public. So with all that being said, let's get right into the video.
Speaking of our next guest, let's do that. And he does warn that the wild swings that we are seeing in some of these types of stocks may be signaling a cruel summer. Yeah, see what we did there with the whole ape. Anyway, for the broader market, Julian Emanuel is BTIG's chief equity and derivative strategist, also a fan of the movie Karate Kid, which that song was featured. Julian, talk to us about your concern. Can you connect the dots between, I don't know, 10 or 15 stocks and the macro market?
You actually can. But first thing I want to say, it's great to see the three of you back on set together, obviously referencing classic rock, and I'm looking forward to playing sports trivia with you all when it's time to take guests again. So you, in fact, actually can connect the dots here. If you go back to January, we saw massive levels of speculation. Obviously, the stock that is the current superstar of this meme stocks right now was not the same one back in January. We all know what it was.
So the superstar right now is obviously AMC, and the superstar back in January was obviously GameStop.
But what you saw was just incredible froth in the options market. Option volatilities of 1,000%. In this case, going back to the end of last week, option volatilities closer to 1,500%. Which really says something in a market that there's been no other clear leadership for the last 2 months, a market where we still believe there is some concern with inflation that the Fed is not properly addressing, and frankly, looking at the number of bears on the latest sentiment survey, which hasn't been this low since right before Volmageddon in January of 2018, and we think if the music stops in these meme stocks, it could, like February and March, cause more volatility in the broader market.
So basically what he is saying is that in February and March we did see a huge downturn in the growth sector. A bunch of SPACs did see huge decreases. A lot of stocks actually decreased over 50%. So 50% of their market cap was wiped out in just a few months, which is really a lot. So with this volatility in the meme stock sector, it's not all fun and rainbows. There is a lot of volatility that comes with it. And if you've been following me for the long haul, we've been going over this volatility as well. So it's very crucial that you guys pay attention to this, because now the call ratio is at all-time high. There are tons of people who are buying call options to gamble on these meme stocks, which just shows the froth in the market, and it has bubble-like symptoms.
Well, so it all comes down to the Fed and interest rates. I think that's what you're saying, Julian. So we're kind of starting to be hit over the head by Janet Yellen, Lael Brainerd, Bullard, others.
I just want to cut in here real quick, and yes, a lot of it does have to do with interest rates. So around the same time that GameStop started falling off and a lot of these other growth stocks started falling off, that was when interest rates were raised. So we went from under 1% interest rates on the 10-year treasury, which was around 0.8% yields at the time, which went all the way up to 1.5%. Now, that is still a very low value, and a lot of growth stocks can still do very well under 1.5% interest rates, which is what it has settled down around. However, just the other day, Janet Yellen has come out to say that interest rates will actually be a very good thing for the economy. Now, will that crash growth stocks? We don't know. But will it slow down the growth stock speed that we're seeing, or the meme stock speed? Well, that's what I think will happen. So if interest rates do happen to increase, I do think that some of these meme stocks might take a hit.
I mean, they're kind of starting to say, guess what? Rates are going to rise. They're going to go up. And Janet Yellen said today, that's not a bad thing. When rates go up, to quote the movie Margin Call, does the music stop or just slow down?
On balance, it's not a bad thing, but we really have to manage this very precisely. You know, in a lot of ways, if you look at the last couple months, and we're almost glad to see the dialogue turning here, Chair Powell has been very, sort of shrugging off the fact that you have these very high readings, and the fact that the economic data leads you to not be able to truly forecast whether inflation is transitory or is becoming more embedded. So what we would say is, in an economy that's growing 6, 7, or 8% this year and looks set to grow at 3 to 4% next year, it's the right time to start pulling back from monetary accommodation. It's the right way before we make the mistake of letting inflation get too embedded. And if we move in that direction, the market could have a knee-jerk sell-off, which ultimately to us is a buying opportunity.
Alright, so basically what he is trying to say here is that since COVID did have a huge hit on our economy, the economy is set to explode in this next 2 years, with about a 7% increase in GDP in this year, and then a 3 to 4% increase in the next year. Now, with that being said, with an economy that is set to take off, there is no need to keep having these low interest rates, which is a form of monetary easing for an economy that is suffering. So this economy is currently not suffering. As we can tell, the economy is pretty much booming now that COVID is coming towards an end. I'm not saying COVID has come to an end, but it's coming towards an end. So there's no real need for the same type of stimulus that we have seen in the past year. And with higher interest rates, that could actually help out the economy in the long run, instead of letting inflation keep on running. Because if we keep these interest rates very low, there will be continuous inflation, and the inflation won't be transitory. And by the way, transitory inflation is just a set period, maybe 3 to 4 months of high inflation, then it calms down. If we keep these interest rates low, if we keep them at 1.5%, which what I said is still very low, then we can see continuous inflation, and gas prices food and other commodities will continue to rise, which is also very, very bad for the economy. Alright, so he basically mentioned that you want to be in the energies and financials of the world because there is a lot of negative correlation to rates in the S&P 500 right now. So what that basically means is when interest rates go up, then a bunch of the stocks in the S&P 500 go down. Now energy and financials, those ones are positively correlated to higher interest rates. So if interest rates do go up, energy and financials are the ones that will be going up with it. So that's basically what his point was, and I agree. Maybe it would be a smart decision to put maybe some energy and financial ETFs in your portfolio as a hedge. You know, it never hurts to diversify your assets. Actually, it really helps your portfolio if you are diversified, because there's always a bull market that's going to be taking off somewhere. It's always good to basically be reactive to some of these higher interest rates. Like we've said, Janet Yellen said interest rates going up would be a good thing for the economy. So don't put it out of the question. Interest rates are a big deal. We saw it earlier when GameStop originally rallied and then it crashed. We saw interest rates go up and a lot of growth stocks did end up crashing. Basically know that high growth stocks that are not financials, are not energy, technology stocks, they do have a negative correlation to higher interest rates. They do go down when interest rates go up. So all I have to say is pay close attention to this and be careful going forward. I hope you guys enjoyed this video. I enjoyed making it as always. I know it's kind of a tough pill to swallow, knowing that some of your favorite stocks may not continue to go up forever and may react negatively to these higher interest rates. However, I wanted to bring it to your attention just so you guys are aware of this, and in times of volatility, that is also times where you can make and lock in a bunch of profits. Now, by locking in, you have to sell. So know when to sell, know when to buy, know what to buy when, and know how to hedge. This is how you can be a good investor in the midterm. For me personally, I like to just long-term invest in stocks that have good fundamentals and just not sell it for a few years. Everyone has a different trading strategy. I tend to stick with a long-term investing strategy, and I like to reiterate this in almost every video I make just so you guys know what my goals are as an investor. I like to talk about the stocks that I like. I still like growth stocks more than these value stocks such as financials personally. However, everyone is different. So with all that being said, that's about it for the video for you guys today. I really did hope you guys enjoyed, and peace.